Well, how bonds behave? Well, just because bonds are considered very safe or more conservative than stocks, it doesn't mean that they don't have any risk. When you buy bonds, it is possible that the issuer itself will default. We're excluding for a second the situation where the issuer is the US government. When you buy treasury bonds from the US government, we're actually saying that that's a risk-free return simply because we trust the US government not to default, we trust them to pay us back. But for any other enterprise, it is possible that the issuer itself will default. Even municipalities default. Just take a look what happens to Detroit in the past couple of years. There is a prominent example of some counties in California during the 1980s that they defaulted on their debt, on their bonds. So it is possible that the issuer will default. If the issuer will default, there will be no one there to pay you back your par value, and that's obviously a loss. So just because bonds are considered safer than stocks, you need to be aware that there is always the risk that the issuer will default. This is called credit risk or bankruptcy risk or default risk. There is additional risk that is involved with bonds. This is called inflation risk. Let me explain how inflation or the general economy is associated with bonds. All right, let's start to discuss how inflation is related to the risk of bonds. So let's start with inflation. Let's call it I. What is inflation? Very simple. When prices of goods are going up, goods and services, prices go up, that's inflation. So let's imagine a situation where inflation goes up. What do you think the Federal Reserve will do to the interest rate in the market if the inflation goes up? Usually the Federal Reserve will also increase the interest rate. Just to let you know, the Federal Reserve meet 8 times in a year, so that's roughly every month and a half. And whenever they meet, they can change the interest rate, push it up or bring it down. Why do you think the Federal Reserve will increase the interest rate when inflation goes up? Pretty simple. This is the way to stop the fast-warming economy. When inflation is too high, they don't want the prices to go out of control. Therefore, they will push the interest rate up. This will give incentive for investors to save rather than spend. Imagine yourself a situation where you have some savings, let's say $10,000 in the bank. If the interest rate in the bank is very, very small, let's say 1%, 2%, you have very small incentive to save. Your money does not grow much in the bank. However, if suddenly the Federal Reserve will start to push the interest rate up, now you have a higher and higher incentive to save. Now you can see that the interest rate is 4%, 6%, 8%. Your money can grow faster at the bank, so you have more incentive to save and you won't spend on things that you don't even need. In this case, you won't buy too many things, other people won't buy too many things, and this will stop the fast-warming economy and the fast rise in prices, which means in the inflation. This is how the Federal Reserve will fight inflation. Now, if inflation will go up, the interest rate will go up. Suddenly, companies will issue new bonds, and remember that companies issue bonds on a regular basis with a higher yield. Why the yield on new bonds will also go up? Pretty simple. This is a competitive market. Now that you can earn a higher interest rate at the bank, now bonds will have to compete with that. If they will not offer you higher yield, higher return on their bonds, you will simply won't buy their bonds. You will take your money and put it in the bank. If you can earn 6% on a CD account in a bank, but a corporation will only issue bonds with, and they will offer you only 4%, there is no incentive to buy their bonds. You will simply put your money in the bank and earn the interest rate over there. That's a competitive market. They will have to compete. So if the Federal Reserve will increase the interest rate, new bonds of new enterprises, companies will have to be issued with a higher yield. And we already saw from the definition that the yield is equal to coupons divided by the price. The yield goes up, it means that the price comes down because the coupons are fixed. In this case, the price will come down. This is clearly a risk, because if you buy the bond at a certain price and one day the price comes down and you really have to sell the bond for whatever the purpose is, you need to sell it and collect the money. So you buy it at a certain amount, you sell it later on at a lower amount when the price comes down, you just lost money, and that's obviously a risk. Let's see the opposite situation. What happens if if the inflation comes down one day? If inflation comes down, there is, let's say, a stagnation or even a deflation. Prices do not move, or perhaps even coming down. God forbid. It's not a very pleasant situation for the economy. But if inflation comes down, what the Federal Reserve will do is that they will bring down the interest rate. This is exactly what happened in the past couple of years. The Federal Reserve pushed down the interest rate right after the crisis of 2008, 2009. They brought the interest rate very, very close to zero. And only recently they started to bring it up again, very, very slowly. But right now the interest rate is still very, very low. It's standing at anywhere between 25 to 50 basis points, which is very, very low. Why are they doing that? Very simple. This is the way to jump the economy again, to push the economy, to give us more incentive, we investors, to give us more incentive to spend rather than save. When the interest rate is so low, there is no point to save. You say, what's the point? I'm not getting any return on my money in the bank one way or another, so let's spend it. You only live once, what the heck, let's spend the money. This is how they give us incentive to spend. If we spend, then companies earn more money, companies are more profitable. This is how the economy is getting back on track, and the prices will start to go up again. So if the inflation will come down, interest rate will come down, companies that issue bonds, issuers, will issue bonds with a lower yield. Why is that? What's the relationship here? Well, the relationship here is a competitive market. Over here, they don't have to compete. Now, pay attention, you don't have any other alternative. You don't have a better alternative to put your money in the bank, get in a CD account or a savings account, higher interest rate. Now the interest rate is very, very low. So why companies will issue bonds with lower yield? Not because they compete, but because they can, because they want. This is what they want. Remember that from the issuer point of view, their incentive is to issue you bonds with a lower yield, lower return. This is how they make the money. So from the issuer point of view, they will issue bonds with a lower yield simply because you do not have, and they know that, you do not have a better alternative to do with your money. Once again, if the yield will come down, obviously prices will go up. If the yield will come down, prices will go up. You can see that because the coupons in the numerators are fixed. Changes in inflation, when either they go up or down, will make changes in the prices of bonds, either down or up. Prices are inversely related to inflation. That's why inflation is a major source of risk for bondholders. Obviously, you do not want to see this much fluctuation, this kind of volatility in prices when you buy something. You prefer stability, you prefer to be able to forecast, to predict what will be future prices. You do not want to see too many changes in the prices. Overall, there is a strong correlation between the yield on bond and the risk of bonds. The risk can be associated with the credit risk, the default risk. Sometimes there are some prepayment risk, something that we will not get too much into in this course, but there is also obviously the inflation risk. Just like equity, the concept in finance is the higher the risk, the higher the return. So here it is the same thing. The higher the risk, the higher the yield. Usually enterprises that are more risky are closer to default, are more in a shaky situation, are more in financial instability. They will have to compensate investors for this risk, and they will have to offer those bonds with a higher yield, higher return. Some of them, as we'll see later on, are called junk bonds. Junk bonds are considered bonds that are issued by very risky enterprises, and therefore they have to compensate investors and issue those bonds with a very high yield, very high return. Sometimes it can be 10, 12, 14%, sometimes even 20% or even more. It really depends on the situation of the bond issuer. Let's start to discuss different types of bonds. And it's only natural to start with US government bonds. We already mentioned that in prior lectures, what are treasury bonds? Treasury bonds or treasury bills or notes are US government bonds. They are issued by the US government, by the Treasury Department. That's why the capital T. And they are divided into three sections. First of all, US T-bills. The T-bills are always, short-term maturity bonds from 90 days up to 1 year, and they're zero coupon bonds. Treasury notes and treasury bonds are longer-term bonds, and they are coupon bonds. So T-bills do not pay any coupons along the way, simply because it is a short-term to maturity bond. But treasury notes and treasury bonds, they do pay coupons. Treasury notes are from 2 to 10 years. Treasury bonds are from 10 to 30 years. Just remember that T-bills are zero coupon bonds, and therefore they are issued at discount, and they have to remain a discount during the lifetime of the bond, which means that the price has to stay below the par value of $1,000, not only at initiation, but also during the lifetime of the bond. This is not necessarily true for notes and bonds, but let's focus on treasury bills for a second, and let me show you a couple of examples about treasury bills. So let's discuss a T-bill. That's a US government bond, short-term up to 1 year. On the horizontal axis, I'm going to measure the time starting from today all the way to 1 year, 12 months. Let's say that right now you can purchase the bond. In 12 months, that's the day of maturity exactly, the bond will pay its par value of $1,000. On the vertical axis, I'm going to measure the price of this T-bill. So the price right at the beginning, right here, you need to pay, for example, you need to pay $950. That's a negative cash flow, you pay $950 right here. So you know for sure what is the price. How do you know that? Pretty simple, they tell you, you want to buy the bond, this is how much you need to pay, $950 over here. The question is, what will be the price exactly at maturity? And I'm going to tell you that the price at maturity on the very last day will be exactly $1,000. Why is that? That's the par value or the face value at maturity. I want you to understand that those are two different things. Par value or face value is defined as the amount of money that you will receive from the bond issuer at maturity on the day of maturity at the end of the 12 months. Price is something else. Price is how much you need to pay on the free market if you want to buy something. So price and par value are two different things, but on the very last day they will converge. And why is that? For two good reasons. First of all, no one is willing to pay more than $1,000 on the day of maturity, or any other day for that matter before that, to receive $1,000. You need to understand that a bond is a contract. It's a piece of paper that says, we're going to pay you, in this case it's a treasury bond, so this is a bond that is issued by the US government. The US government will tell you, this contract guarantees that we will pay you $1,000 exactly at this point in time. No one is willing to pay more than that to receive $1,000 a second later. Imagine yourself that we're 1 second before maturity. You definitely don't want to pay $1,001 to receive a piece of paper that says in the next second the US government will pay $1,000. That's clearly a loss and no one will do that. On the other hand, if you will try to bid below $1,000, let's say $996, someone else will come and bid above you, try to steal the bond from you, and then still get some positive return. So imagine yourself that we're 1 second before the bond will mature. The US government will pay $1,000 to the bond holder. If you are holding the bond and the bond's price is $996, someone will buy it from you at $998 on the free market. Try to earn the $2. $2, and then someone else will buy it at $999, try to earn $1, because in 1 second this piece of paper will pay the bondholder $1,000 from the US government. And then someone else will buy it at $999.50, and so on and so forth. And very quickly you will see that towards maturity, the bond price will converge to the par value. It's very simple. It's like holding a piece of paper that says this is worth $100. How much are you willing to pay for this piece of paper that says $100? Obviously $100. That's about it. On the day of maturity, the price must be equal to the par value. But once again, just make sure to understand that these are two different things. Price is how much you pay for something that you buy. Par value is how much you get at the very last day, at the day of maturity, from the bond issuer. Okay. So we know now that we start the bond here, and we know that the bond will end up here. The question is, what happens to the bond during the lifetime of the bond? In fact, the bond price can take any shape or form. Bond prices may go up and may go down during the lifetime of the bond. Why do we see that the bond price go up? Very simple. Remember the mechanism. When yield comes down, when inflation comes down, the interest rate comes down, the yield comes down, prices go up. So during this period of time from here to here, it is possible that inflation went down. That's why prices went up. Why do we see that prices from here to here went down? That's because inflation perhaps went up. If you remember, when inflation goes up, interest rate goes up by the Federal Reserve, the yield goes up, prices come down. So because of changes in inflation, it is possible that prices move up and down, but two things we know for sure. We know for sure that they start here, we know for sure that they end up here. What happens on the way, there could be all kinds of things. Now let me ask you the following question. Take a look at that. Imagine yourself that on the day of the bond issuance, you were sleeping and you couldn't get up in the morning. You did not buy the bond on the day of the issuance at $950. But you woke up after 1 month. You had a heck of a sleep here. After 1 month, you woke up and you have decided to purchase the bond at whatever the price is on the free market. So right now, the bond price, just for the example, let's say $960. This is the point that you buy the bond. You said to yourself, okay, I still didn't get it at $950, but I will buy it at $960. This is still a $40 return. I buy it here, I'm going to sell it here at $1,000. I'm going to earn $40 over a course of 11 months. And that's still a positive return, good enough for me. That's fine. Unfortunately, 2 months later, so that's 3 months from initiation, from here to here there are 2 months. 2 months after you purchased the bond, something happened. You had to have the money, you have an emergency or whatever the situation is, you have to raise the money, you have to sell your bond. You didn't plan for that, but life sometimes takes you by surprise. So you have to sell it at that point. At this point, the price goes down, let's say, to $952. Take a look what happened. You bought the bond at $960. You sold it 2 months later for $952. You just lost $8. This is clearly a risk. That's the risk of losing money. But I told you so far that treasury bills or treasury bonds are US government bonds, and they are considered as risk-free. We call them RF, risk-free, because they carry no risk. So what happened here? Am I lying to you? This is a US government bond, it's considered risk-free, and here I'm just showing you that you lost money. How is it possible? How can you lose money on a risk-free investment? Well, the answer is pretty simple. Something is considered risk-free only when you buy it at a certain amount, you know for how much you will get it at the end, and you also know the time frame. Something is considered risk-free for like a US government bond, treasury bond, only if you hold it until maturity. Only then you know exactly how much you pay, you know exactly how much you get, and you know the time frame. That's the only reason why it is considered risk-free. If you do not hold the bond until maturity, it is not considered a risk-free investment. So pay attention and make sure to have this, make this distinction. One more thing I want to say, two more things I want to say about this chart. First of all, is it possible that the bond, we know that we start here and we know that we end up here. So is it possible that the bond's price will fluctuate in huge kind of fluctuations? Something like that. Crazy, crazy fluctuations. Can you imagine a situation like that? And you can think about the craziest situation that you want. Maybe inflation goes up and down, whatever it is. This situation is still not possible simply because of this part. No one is willing to pay more than the par value of $1,000. The price cannot exceed the $1,000 simply because T-bill is a zero coupon bond. So just remember, zero coupon bond, they're issued a discount and they have to remain a discount during the lifetime of the bond. So here you have to think inside the box. Prices start here, they end up here. They can change, they can fluctuate during the lifetime of the bond, but whatever happens, you have to stay under $1,000. A normal yield curve for bonds, usually what we see is, if this is the price of a bond measured in dollars, and this is the time, if this is the starting point and that's the end point after 12 months, for example, so that's the par value and that's the initial price. Usually what we see is those kinds of fluctuations with kind of convergence, an upward sloping concave function for the price to go up. Okay, prices can definitely fluctuate, but usually what we see are minor fluctuations like that with an upward sloping concave function like that until the very last day, until the maturity day, where the price will match the par value. This is a typical yield curve for not only treasury bills, but for all kinds of bonds.